Great, welcome. Thank you for attending our conversation around maximizing tax law for charitable giving and wealth preservation. We really hope you find our discussion insightful and leave with takeaways to share with your friends and your family even. I'd like to take a moment to introduce myself briefly and then introduce our two guest speakers. So I'm Jeff Dobyns. I'm the president and founder of Southwestern Investment Group. We're a large comprehensive financial planning and investment management firm which oversees about $6 billion of assets. We're based here in Nashville. In addition to serving as president, I lead a team of dedicated staff and experts to serve a select group of high net worth families with their tax, estate, asset planning, and specifically their charitable strategies. So I'd like to introduce our two guests. First is Bill High. Bill, if you would say hello and a quick little background on yourself.
Jeff, really good to be here. I practiced law for about 12 years, big law firm in Kansas City, and I've been in this charitable foundation world for almost 21 years now. So again, really good to be with you here this afternoon.
Great. Bill is, we'll get to here in just a second, but I'm really honored and thankful to have you join us, Bill. You're going to be able to teach us a lot. And our other guest panelist is acclaimed expert works with the Now CFO organization based out of Salt Lake, Joe Milam. So Joe, thank you for joining us. Appreciate your insight.
Thank you.
We are going to kind of do a cross-panel discussion here and really going to introduce a lot. I think you will find this educational. Bill founded the Signatry, which is the preeminent firm at helping business owners transition equity tax-free, both at the sale of the business and then also after the transactions to manage the funds for your family and for the next generation. So over the last decade, our team's really enjoyed the relationship with Bill and the Signatry. So he's got a special place in my heart, and I'm grateful for him. I'm just going to share a little bit of the backstory of why we think this might be so important. Obviously, selling a business is a significant liquidity event, which also often leads to a major tax liability. So the standard scenario, which many of you might have experienced or heard friends experience, they receive the largest check that you've ever received at the time of the transaction, and then you turn right around and write the largest check you've ever written to the United States government. And then potentially divide the rest of that money for your family, for charity, for other things. So that doesn't have to be the standard protocol. Through charitable giving, less money can go to the government through taxes, more can go to investments that truly matter to your family and the charitable organizations that you're inclined to support. The nice thing about the tax strategies we're going to discuss today utilize what is known as a donor advised fund. So we'll be using different phrases for that, but the primary benefit is a donor advised fund. So maybe we'll start there. Bill, if you would just give a brief summary of donor advised fund and why they're important and how they're utilized.
Yeah, thanks, Jeff. So donor advised fund, people sometimes think that they're a new invention, but they go back to 1914 in Cleveland, actually. So some of your stomping grounds, but yeah, they started in 1914. And the essence of a donor advised fund, it's really like a charitable bank account. You can open up an account, put money in, take a tax deduction, and then use it to support the charities that you want. Of course, with today's innovation, you have people that are able to log in, username, password, start distributing to the charities that they want. It's a really useful tool because if you do all your giving through the account at year end, you'll get one tax receipt. So it is, if you will, the easy button around charitable giving. But as you're alluding to, it's become far more than that. It's become one of the most powerful tools as it relates to the planning process, particularly as it relates to the business sale kind of process.
Okay. Our journey started with this probably a dozen years ago. I worked for a local nonprofit here, a volunteer called Men of Valor, which does prison ministry work. And as part of the finance committee, I was counting checks after our breakfast. Our goal was to raise $800,000 or $900,000. And so we're sitting there reviewing everybody's checks. And I was just seeing check after check from wealthy Nashville business owners, real estate guys that have tons of real estate. And all these were personal checks. And so I just couldn't help but think, gosh, these guys have to know about donor advised funds and charitable planning. So I started to ask them, and none of them were educated on how to do this. And it was really started a journey for me over the last decade to try to learn why is that and how do we do better. And so that led me to a friend, Greg Murtha, who worked for the Halftime Institute, to say, Jeff, you've got to meet Bill High and learn about what the Signatry's doing. So if anybody knows, if really this message will apply to business owners, and as we'll get to here in a bit, anybody that has any type of appreciated assets, if you're writing checks to charity, you're not doing it in the most efficient manner. So we're going to talk a little bit about that as well with Joe. So Joe, anything in particular that you want to get started off there on how we can strategize to reduce our taxes pre-sale might be something interesting to talk through.
Sure. So what we really focus on here at Now CFO is positioning all those companies for exit. So we really do focus in on the balance sheet, the P&L, tell them the best possible financial story for the company so that the CEO gets the maximum value possible for their company. And there are currently there are limitations within the IRS of what a company itself can invest, or not in so much invest, but put toward charity. And so it'd be interesting to see, Bill, what are some of the situations that you run into, with business owners where they want to contribute, but they're limited by the IRS with what their business can contribute versus what they personally could contribute.
Yeah, that's a great question, Joe. The really simple answer to that, of course, is, for some companies, if they're an S Corp or an LLC and they're passing through, then they can actually be able to take the maximum tax deduction, the 60% of adjusted gross income tax. Now, of course, last year was an unusual year, and you actually saw people who could give 100% of AGI. But to your point, 60% of adjusted gross income if you're an S corporation or if you're an LLC. And so that's where we try to encourage people to start with is how do you maximize your income tax savings? And so, Jeff, to the point, that's actually where we always encourage the business owner to start is every single year, make sure that you're maximizing your income tax deduction. That's 60% of adjusted gross income. And then the other point, Jeff, where you were going is on top of that, what people fail to realize is that of the 60%, 30% of that can be using capital assets, publicly traded stock. Even about a week ago, I came across a family that they did not realize that they could give publicly traded stock before they sold it. And of course, they could give that stock into a donor advised fund, get the maximum income tax deduction, and then when the stock sale, be able to give it away to the organizations that they care about.
So, Bill, I'm reflecting back on another CFO, Joe, that you'll get a kick out of this, but his father owned about $30,000 worth of stock. He was a pastor, lived in Chicago, never made a ton of money, obviously, as a pastor, but owned a little bit of stock that it was in a company that got bought by another company, and ultimately that company valuation took off. It went to about $1 million, literally overnight. The company made undercarriages for Humvees ultimately, and this was in one of the Iraq wars, and so that company's stock went from $30,000 to $1 million. This guy's father was able to put that $1 million into his donor advised fund, liquidate it and diversify, received $1 million tax deduction, which as a pastor probably didn't really need, but it was well worth it. But he did save all of the capital gains tax of over $200,000, and then had that $1 million in his giving fund to give to charities of his choice. So, Bill, that's a great point. We don't need to do it only at the time of sale for a business, but these are strategies that really everybody on this call who has appreciated assets and does any type of charitable giving needs to understand and learn how these strategies work. Would you agree with that?
Oh yeah, I mean, again, it comes back to the basic idea. If you consider a donor advised fund like your charitable checking account, everybody needs a checking account to pay for groceries and to pay the mortgage, but you can use that same idea for all your charitable giving, use the donor advised fund. And then as you approach year end and you're trying to maximize your income tax deduction, make that gift a publicly traded stock, or if you get the bonus, whatever it is, drop those dollars in there, and then you've got the immediate income tax deduction, and then you've got time to determine where to distribute it. But this goes back, Joe, to what I heard you talking about a moment ago, which oftentimes what happens is we see business owners in particular, they go through the whole year, they run, and they get to year end and think, okay, I got to figure out my income taxes. And all that happens is they have the financial advisor or the CPA say, well, tell me what my tax liability is. And then they get the bill and they go, bummer. And that's all they do. Isn't that your experience as well?
Yeah, it is. It is. It's usually a rush. And whenever you rush, you guys know what happens. Mistakes are made. Things are overlooked. So that's the advice I have for anyone that's going into month end or year end is take your time, step back, make sure you have everything accounted for, and especially on the charitable giving side of things. So anyway, I just the thing that I see is rush, and mistakes are made.
Yeah, Joe, you made the comment earlier off air that the just take a breath of what, and kind of walk through that story if you wouldn't mind, of because this if it hasn't yet will start to happen to a lot of the people on this call that are running a company as a CEO, and then all of a sudden some private equity group comes out of the blue and makes them an offer. Could you kind of walk through with your experience? You had some great analogies there of how that happens and maybe what they should do to slow that down a little bit.
Yeah, again, kind of talking about putting the brakes on. So one of the things that Jeff and I were talking about is the importance of maximizing the value of your business so that you can maximize your wealth, your family's wealth, and what you can give. And it comes back to sometimes that first knock at the door, right? And that either that private equity guy comes in with a very nice, what you would consider very nice offer, probably a little bit ahead of where you were thinking the business was. And you typically then react and you go down that path and you do a transaction, only to find out about 6 months, 8 months later that your business was sold again for a much higher valuation. So the idea is to just, when you get that first offer, which I know a lot of you guys probably are right now, just take a breath, reach out to your financial advisors and consider other options. Don't just take that first offer. Jeff, I would say that would be the most important thing, is just to slow things down and make sure you're not leaving any chips on the table, even though it's the first time you're taking chips off.
Good. Bill, any horror stories you can share with us there?
Yeah, I can. I mean, one of the very first deals I worked on was with a guy named Dennis. And much like Joe's point, he had built the business over about 25 years, and it had escalated in value dramatically. But when the first private equity offers started coming in, all of a sudden he was thrown into a process that took on a life of its own. And he didn't have time, actually. He ran out of time to do any of the wise charitable tax planning that he should have. He called me after the deal was done, after he had already written the checks to the IRS, and he did give cash, but the amount of cash that he gave to the amount of tax that he paid were substantially different. So sometimes, if it's okay with you, I'd like to show you kind of the illustration of it. So I have in my hands this little blank piece of paper, and I use this to illustrate. Imagine that this is this guy's company. So he started it here at the bottom, and then the company grew in value. So let's just say it's a $50 million company. If he rushes to the sale, to Joe's point, then the way I illustrate it is just like that, off the bottom, he loses 20 to 25% in capital gains tax if he does nothing prior to the sale. That's all tax. That's a bummer. He just throws it away, literally. And so the question is, can he do better if he is wise and donates before the sale? So in a $50 million kind of business, that could be $10 million of tax that he's having to pay. And so what we'll illustrate is that if that same person, that same business owner would say, wait a minute, I'm going to give 10% of my business prior to the sale, put it into a donor advised fund. That 10% becomes an immediate income tax deduction, $5 million. He doesn't pay any capital gains on that. He gets an income tax deduction that he can use to write off against ordinary income. And that's just an income tax strategy. That's not even at the point of sale. So sometimes I have business owners who they compare that 20% and they look at this little 10% piece and say, could I go back and do this from last year? So that's a good physical illustration of it to demonstrate the concept.
Well, Bill, that's and you and I both know a great guy that unfortunately, and I've maybe shared this story just to set the expectations of the importance of getting good advice. He is in his 80s. His whole passion now is to give this $80 million, which was the sale of his banks, to charity. But unfortunately, he asked his accountant if he could donate the proceeds or the business to his private foundation before the sale. And the correct answer, unfortunately, from the accountant was that you cannot do the private foundation. But what he didn't ask was, or suggest that you can do that through a donor advised fund. And so this client ended up doing exactly what your illustration there was, wasted about $19 million of income taxes that really could have gone to great causes that he's passionate about, because the accountant did not say, no, you can't put it into the private foundation, but you can use a donor advised fund.
Yeah, the donor advised fund, again, it's considered a public charity, but you're putting it into your account. And then that way, when the buyer comes in, they're buying from you personally, but then they're buying these proceeds from your donor advised fund. And again, the rules are less restrictive in a donor advised fund they are in a private foundation. So oftentimes in a private foundation, you only get a basis deduction, whereas in a donor advised fund, you're getting a full fair market value income tax deduction.
What would you two say, now we know kind of the importance of the criticalness of getting this done right, what are some ideal timing questions if somebody wants to do some charitable planning? When's the best time to get advice, and to whom do you get that advice from?
Yeah, Joe, do you want to start there? I mean, I've got my own thoughts, but I'd like to hear from you on this.
Sure. So, for me, it's the conversation up to the exit. So, it would be talking with someone that could truly help you understand the business value that you're working with, and have an idea of what the market will place, the value the market will place on your business. Remember, it's not an investment banker. It's not an attorney friend of yours. It's not even your closest partners that will determine what the value of your business is. It's the market once you go to sell. So, I would say just do the best you can to figure out what marker you're going to hit when you do exit, to help you determine if now is the time. Are you going to reach your personal goals? Are you going to be able to contribute what you wish to charity? Is your family going to be in good shape? So those are the important things that I would say to consider rolling up to an exit.
Yeah,
Right.
Joe, I think that you hit on one of the things that I want to talk about, which is valuation. And so to your point, Jeff, we actually encourage that business owner to start this process typically at least 3 to 5 years in advance. Because 3 to 5 years in advance, usually if they're thinking about this, they've already been building a good company, they've got a strong history of profitability, and so now they've got income tax issues. So back to my idea of the guy given a 5%, 10% kind of interest, they're starting the process just with income tax reduction. They're capturing that 30%. So if you've got the guy making $1 million a year and he gives 30% using an illiquid asset, now he's got a $300,000 income tax deduction. He just cut his tax bill. That typical business owner, we're going to save him at least 6 figures on income tax. Then at the point of sale, when the sale actually occurs, usually they're going to actually need to give more because the valuation, to Joe's point, is going to come in. It's actually going to show a growth in valuation. And now we're able to actually do a larger gift to be able to minimize the taxes, the capital gains and the income tax. And now we can sell this interest out. But I know where some of you are going is all of this is that we have to have the gift and the tax planning done before there's a purchase agreement. You can't sign the purchase agreement. Even last week, I got a phone call from somebody that was actually a nonprofit, said, hey, we just had this client that sold their business and now they want to give. And of course we're going like, oh no. Well, they paid, in their case, it was $1 million tax bill that we could have at least cut that bill in half if they would have come to Joe or myself, yourself, prior to signing that purchase agreement.
Well, it's interesting how, and what I've noticed is how much work and effort and energy all these consultants, advisors, attorneys, tax people, investment guys spend on trying to mitigate some minimal taxes, but it's these massive amounts of dollars that can be saved if there's some forward-looking thought into what's the client's objective and how do we really help them do that. So I'm really grateful for Joe and Bill spending the time with this session, because this is really all proactively of how do you help the business owner and his family or her family accomplish the objective, which in this case is to make as much money as you can at sale, pay the least amount of taxes as possible. I love that old Arthur Godfrey quote. I'm proud to pay taxes in the United States, but I could be just as proud for half the money. And then what do we do well with the proceeds? And Bill, would you talk a little bit about kind of after this thing occurs and the money is in their giving account or their donor advised fund, kind of how does that work?
Yeah, I mean, once people have the account set up, and so you started out with that piece of paper that represented 5-10% of your company, and now you sell it. Now you got cash in there. Now you're actually able to distribute to the charities that you want. And well, in many cases too, what we're going to see is we're going to see those owners gather their family together, and they're actually going to use that as a chance to talk about what are our family values, what are the things that we care about. Even on Saturday, I was with a family, and they were talking about the fact they're in the hospitality world, the restaurant industry. So they do a lot with homeless, and they do a lot with feeding organizations, as you would expect. But that's what their family has rallied around. And they are one of the most unified families that I've seen in terms of what they do, because they really care not only about their family, but how they make an impact in the community. So this donor advised fund is like that family foundation where you can have these powerful conversations around charitable giving. And at the same time, it becomes a place where you can actually teach some of the things that Joe teaches or that you teaches about financial responsibility and how do we deal with tax? How do we look at the financial statement? All those kind of ideas as well.
Hey, Bill, I love that point, because it's almost like, I mean, you're instilling these thoughts into the company culture, and you can start as soon as now with those discussions. I mean, it's best. It almost becomes a part of your best practices on as part of your business. So
yeah, and I think, Joe, you're hitting on a really huge topic. That's why I always say, don't wait till the transaction. Don't wait till the 11th hour. Start 3 to 5 years in advance, but deal with the income tax, create the account, start the giving, start the family conversation. So that way, when you get to the point of transaction, you're already ready.
Right.
You know what's going to happen.
And you've reduced conflict. You've reduced so much of what would happen if this conversation's taken place at transaction date, when you have family members that may not agree with this overall plan.
Yep. By the way, I want to throw a question back to you guys, because in our space, one of the things that we do see, of course, is we have clients come to us all the time that don't have advisors who are frankly even aware of this strategy, this kind of conversation. So from your vantage point, what would you be telling clients? Because we end up with ones sometimes who don't know, the guy that already sold his business. So what would you be telling clients to be looking for?
Go ahead, Joe, and then I'll follow up.
No, I think this is something that needs to be part of advisors' conversations with CEOs that they're working with. And again, as we've talked about, those conversations should probably be taking place sooner rather than later. And to work closely with their CPAs so that they are looking at the bigger picture from a taxation standpoint, and be able to cause real change earlier in the growth of the company rather than at the end of the day. So I think, again, sooner the better. It's worth it to have those conversations now.
And Bill, from my perspective, we feel God owns our business and owns everyone else's business, and has just asked us to be stewards of these resources. So from our perspective, we're just trying to say, and we spend a lot of time with our clients, of how much they really need to sustain their lifestyle, to accomplish those goals. What's the real vision for how much they want to leave to their children, grandchildren, and then what do they want to do with the rest of those dollars. And so that's really where we have an awful lot of fun, is to try to say what really is all this money for, what's the purpose, and what's the legacy going to be. And then these are just tools and strategies to accomplish that.
Yeah, I love that idea, because in that context of the business, and when it does get sold, there's this amount of wealth that remains, but we just try to encourage that wealth is far beyond the financial side. And so to the extent we can use this charitable giving conversation, so we try to say, use your wealth to preserve the family, not just to preserve the wealth, the financial wealth. Usually that starts at that charitable giving conversation. And so if we can help that business owner minimize that tax liability in favor of this bigger pot of charitable giving, that's one of the easiest things. One little other aside that I think that I always like to share in these kind of contexts. So you've got the guy that sold the business, he's got that set of dollars inside the donor advised fund, he's having the conversation with the kids, doesn't matter how old they are, but one of the little things that people don't realize is they can actually make charitable gifts directly to individuals in need through an organization called Helping Hands. And one of the most powerful things for kids in particular is to see the direct impact of their gift on the life of somebody, whether it's to help pay for the medical bills, maybe it's the family that got cancer, somebody that couldn't pay their rent, and it's their next door neighbor. Well, there's ways that you can get some of that direct impact giving done. And it all started with that guy that had the business and realized the opportunity to maximize sale and minimize taxes.
Bill, I'm glad you brought up Helping Hands. Just last week, we have a PGA professional who's just a great guy, and they've made an adoption of a little boy, and his biological mom's having some financial issues, and car broke down, and so they wanted to buy the car. And so we said, let's get you in touch with Helping Hands so that you can buy the car, but we can also receive an immediate income tax deduction. So all these things, and this is what Joe spent his whole career on, is how do you try to set up companies, how do you reduce taxes, and how do you structure things properly? And so a little phrase we coined is never write another check again to charity, and that kind of freaks out all of our nonprofit friends because they think that we're trying to cut out giving. What we're saying is we love giving. We're obsessed with trying to increase generosity, but you want to do it in a way that the government blesses, because you can increase your giving by a significant lever with utilization of some of these strategies. So Helping Hands is based in Atlanta, a great organization, Bill, so thanks for sharing their name.
Yep. So Joe, coming back to you for a second, why is it, again, I want to come back to that, why do we see so many business owners rush towards transaction and never get to address some of these larger planning strategies?
I think it's the opportunity, and it's the fact that they have they always have an exit. Everybody has an exit in mind, and maybe that exit, all of a sudden today, oh my gosh, I can sell my business. I can hit some of those markers that I want to, and so it's just their natural reaction to to the value that they are placing on their business that day. And maybe it could have been a rough day. It was a rough month. Maybe it was just, it's a multitude of different reasons why a CEO will just take that first offer. But I most of the time, I think it's just ease. The fact that I didn't have to go and find this person. They're actually knocking on my door and they want to write me a check for my business. And that's, I mean, I would advise against that all day long. I mean, of course, unless it's a strategic and they're coming in with 12 times, something absolutely amazing. It's just always better to slow down, just make sure you are truly maximizing the value of your business, and it usually takes the second or third. And sometimes those second or third offers will pull that first one up to really where the market's more credible for them.
Jeff, what do you see? I mean, that question about why do we rush towards transaction without ever getting to these kind of strategies?
Yeah, I think, as you know, when you're running a small business or a large business, but you've got all that responsibility. And so it's just tough to, I think, analyze all of this stuff on an ongoing basis. And most of these experts, most of these folks on this call are running hard, wearing a lot of hats. And at best, we have a couple trusted advisors that we can go to. And so I think it's obviously very important to try to find good folks. One of the challenges we see is that not everybody is updated in some of these strategies. And so you might ask the accountant, they've never had experience with using a donor advised fund before for a business interest and they don't think it can be done. Or as the example earlier, the longtime accountant thought that the private foundation could not handle it, which is true, but he didn't think to ask the question behind the question of what are you trying to accomplish? Mm-hmm. Because there could have been another solution as in the donor advised fund. Is there something, Bill, that you, and I want to ask you, that you think is number one, and then number two, while we'd love to have 3 to 5 years of planning and preparation, kind of walk through worst case scenario, something happens quickly and somebody shows up with an offer to buy somebody listening's business. As long as we haven't signed that sale yet, we can still do it. But would you kind of walk through kind of how that works and what the process is?
Yeah, I'll cover worst case scenario, and then I do want to come back to some of this. Okay. But short of it, on the worst case scenario, if you have in fact gotten up to the 11th hour, don't throw in the towel and say, boy, I just don't have time. We have had people approach us at the 11th hour and say, I'm going to sell, it's urgent. We're going to sign the purchase. They haven't signed the purchase agreement, but we've had to get deals done literally within 24 hours where they make the gift. And even the next, it's not preferred. Joe can tell you this is not preferred, where they make the charitable gift the day before the sale. So it is possible to do it even if you have waited until the 11th hour. We wrote a book, though, back to the first question. We wrote a book a few years ago that I contributed called Sell Well, and it actually talks about some of this mentality. But one of the things that we encourage is evaluate your advisor team. Do you have the right tax person? Do you have the right financial advisor? Man, if you started the company 25 years ago, chances are the advisors you started with aren't probably the right advisors for you in the midst of that transaction. I can't tell you how many times we've had deals killed by the lawyer or the accountant because they hadn't kept up to speed. And then, frankly, we encourage you to have the charitable tax planning specialist, somebody that actually lives in the space, somebody from the donor advised funds space, oftentimes, in many cases, at the table with you. But the other piece, too, that we encourage is also somebody, and Joe, I think you've affirmed this idea, and just like you've said, Jeff, somebody that actually can say, how's your family going to be impacted by this? The subjective side of the deal.
Well, that's great advice and encouraging. Is there any, we've got just a few minutes left here before the Q&A, any technical components that you two want to address, whether we're talking about if it's a C Corp or an S Corp or an LLC, or if it's not a business interest, but it's a music catalog or a piece of real estate or a building or a simple public stock. Is there any technical issues there that we need to be sure that we cover?
I'll throw out a couple things and maybe Joe can jump in. So typically, of course, you do need to have a valuation done. You need that valuation done prior to 60 days before the sale or 60 days after. So you got to have something like that done that's at least relevant in time to the actual donation. And then typically with regard to these kind of donations, particularly as it relates to real estate, as you'd prefer lower debt or little debt, those become some of your practical ground rules. The more shareholders that you have, the more time you need to have to review whether or not you need consents, those kind of things. So there are practical kinds of things that you need to do to get ready for these kinds of gifts.
Great. Joe, anything that we've missed there?
No, I think Bill just did a great job. There are definitely considerations on the business side, with IRS and taxation. But no, outside of that, I think we're good.
Okay. So it sounds to me like a good summary for that is it's important for folks to get in touch with their experts on the accounting side, the legal side, their wealth and management side, and then certainly the donor advised fund world. Bill, would you talk just briefly, we've got just a minute or two, but the difference between a foundation, a private foundation, and maybe why donor advised funds are a little bit more practical for situations like this, a little easier, a little more valuable.
Yeah, by the way, to wrap up all that conversation, we say friends don't let friends sell businesses until they dealt with the charitable tax side. So anyway, but on the private foundation side, it's a corporation, it's bylaws, you file a tax return, and contrary to the term, it is not private. All of your giving, everything is known inside the private foundation, and the tax deductions are lower basis kind of deductions. So we don't see many people choosing private foundations, whereas a donor advised fund is an account inside of a donor advised fund organization. Higher tax deductions. And for so many of us, we are concerned in today's kind of cancel culture, your giving can be totally anonymous. You don't file a tax return. So today there are 800,000 donor advised fund accounts in the country, and there's only 80,000 private foundations. So that tells you something about what has now become the choice when it relates to the charitable giving tax structure.
Okay. And those donor advised funds can continue for the life of the donors, plus also for the next generation. Is that true?
Yeah, totally. I mean, in our case, we allow for multi-generations. Our goal is to sustain families and ultimately the community impact, so we can have families that continue on with these donor advised funds for generations.
Great. Joe, we better wrap up here. We're going to be moving into the Q&A or the post-session discussion here in just a second, but any final parting words before we start to take questions?
Well, no, guys, really enjoyed the conversation. Bill, love what you're doing, and looking forward to working with you.
Great. Well, Bill will not be able to be here for the Q&A, so we are grateful for what you're doing with the Signatry and leading our nation in kind of this charitable giving and legacy and family. So Joe Milam with Now CFO, thank you. And Bill High, founder of the Signatry. Bill, thank you.
Thanks so much.